What's going on, everyone? Welcome back to Courtside Financial. My name's Obi, and if you're new to the channel, make sure you hit that subscribe button so you don't miss out on the next video, and also make sure you hit that like button because it really does go a long way in helping out the channel. So today we're going to be talking about ARKK. It's an ETF that encompasses an actively managed fund centered around innovation. So what exactly is an actively managed fund?
So Tim, you opened the door to this discussion when you brought up actively managed ETFs.
Yep.
So as we talk about it, I mean, you're an active trader. You are a trader on fast money. So how exactly do some investors or even asset managers look towards creating products and then actively trading the portfolio to create value that is then passed on to the holders of those particular instruments?
Look, if as an investor you can invest alongside of a manager, invest in a manager who is actively monitoring a portfolio and going through the same stress testing that a long-short equity manager, for example, which is what I did for 13 years, is doing, you're getting the best bargain in the business. That's when you really have to ultimately understand who you're investing in. So to the extent that managers like Ark Invest can be taking this area of the economy where there's enormous innovation and where there's an opportunity, I think that's fantastic.
So I'm a long-term investor. I'm by no means a professional trader, although I do have a separate brokerage account where I do trade with a little bit of money. I don't day trade, I just make swing trades on that, and all of them have been profitable. So if you follow my channel, you know that my investments are very centered around innovation and disruption, and I actually do use a lot of Ark Invest research for the topics that I tend to study. So this ETF specifically makes sense for me because it provides me some more diversity, and I put my risk of trading into the hands of a professional with a successful track record. Over the past 5 years, this ETF has generated a 311% return. Now, compared to the S&P 500 over the past 5 years, the S&P 500 has generated a 62.32% return. So obviously, Ark Invest has way outperformed the S&P 500. Now, these returns were made possible for them because they invest in disruption and they hop onto these trends before they actually materialize, which disruption and innovation can actually provide outstanding returns because you're there before anyone else is thinking about it. But having someone actively manage your money doesn't come for free. Specifically, this ETF has a 0.75% expense ratio. Now, you might think that that's kind of high, but in my personal opinion, the returns that they've generated over the past 5 years have more than paid for that. Now, obviously, past performance does not indicate future success, but I think that over the next 5 years, they will once again way outperform the S&P 500. So I'm willing to pay that 0.75% in the expense ratio. For comparison, the ETF VU, which is a ETF by Vanguard that actually mirrors the S&P 500, has an expense ratio of 0.03. So that's pretty much nothing. So aside from having all that figured out, what's important for me to understand as an investor is their top 5 holdings. Do they make sense to me? For the way that I'm going to be investing in this, I'm actually going to be dollar cost averaging, putting in money twice a month at the same dates. Regardless of price, I'm putting in the same amount of money. So even though valuations are sky high right now, if there's a correction in the market or in these stocks particularly, it will balance out. We've talked about Tesla so many times on this channel, and obviously I'm very bullish on electric vehicles as a whole. I think electric vehicles will only have more market share over the next 7 to 10 years or so. Tesla leads the industry, so they should get a disproportionate amount of that market share. Most recently, they reported their 4th consecutive quarter of profitability, which means that they could get S&P 500 inclusion. They've announced a 5-to-1 stock split, so for every 1 share of Tesla that you hold at the time, you will actually be getting 5 shares. So if Tesla is at $1,500, that means that you would have 5 shares of Tesla worth $300 each. And of course, like we always say, Tesla is more than just a car company. When an investor invests in Tesla, they're not investing specifically for the cars. There's many other facets of their business. You think about Tesla Solar, you think about Tesla Insurance, you think about their robo-taxi network. How do all those things play into the story? Tesla is very much a story stock. So Tesla, I'm definitely going to give that one a thumbs up. If you guys know me, then you probably already knew that. Next is Invitae. I will say that I'm not very well versed in the biotech industry, so I don't really dabble around in this sector or even try to individually pick stocks in this sector. So Invitae is in the genetic space. They use genetic information to guide healthcare decisions, which brings down the cost of reliable genetic testing. So if they're able to accomplish their mission, I think there's huge upside here, because anytime there's someone in the industry who's able to bring down costs, that makes it the more efficient thing to do, which means that more customers will start coming to them and providing them with revenue. Due to the Roni situation, we're in unprecedented times right now. That has had a negative impact on their business. Most of the focus in the medical space has just been on, figuring out a vaccine and trying to better the situation that we're currently in. The volume of diagnostic tests has decreased by 50% in the last 2 weeks of March for the company. So in my opinion, this is a short to near term headwind that the company is facing. So I definitely think things will improve over time, and the amount of specimen that they have received is still up 64% year over year as of Q1 2020. Now for Square stock, I've actually been looking to purchase this one or PayPal individually, because I think that they are huge players in fintech, and I think that both of these companies have a good chance of being disruptive to the financial industry over time. PayPal is definitely a familiar name. Square is also a familiar name to me, but like I said, valuations are sky high right now. So individually, I would not be purchasing either of these stocks. That's just my opinion. I think I can get them a little bit cheaper if I have a little bit of patience. I mean, Square has a PE ratio of 237, so in my eyes, it's trading a little bit rich right now. But with this ETF, I'll be dollar cost averaging, so by default, I'll be buying less when the stock is high, and I'll be buying more when the stock is low. Q2 earnings were great, and I like the company. Next, we have Crispr. I've been hearing about Crispr since I was in school. I'm by no means an expert in this space, but I do know that there's a race to chart the human genome between the private sector and the governments, and Crispr is obviously a huge player in the private sector. They have a focus on genome editing, so on the surface it seems like they have huge potential upside. Individually, I wouldn't invest in this stock because it's far outside of my realm of understanding. Here I will invest with Cathie Woods as the fund manager. PE ratio is pretty high here as well. It's 191.5, and the stock is up 192% for the year. Lastly, we have Roku. I think a lot of people are familiar with this one. I use my Roku every day, and I don't pay for cable. I think streaming and Roku and Fire Sticks and things of that such are going to be extremely disruptive to the way people consume content these days. I know I spend a lot of time on YouTube. I know if I want to just turn on my Roku, then I have television right there, things that are being broadcasted, the news, whatever I'm looking for. So Roku is not profitable right now, and I think that they could have made the choice to report small profits, but instead they're reinvesting back into the business and really trying to scale it so that in the future they can report bigger profits. In my opinion, that's a smart business move. Q2 earnings were great. They were expected to report negative 51 cents per share, but instead they reported negative 35 cents per share, so they beat on that estimate by 16 cents. Stock is only up about 9% this year, but in my opinion, one of the best ways to find growth is to invest in companies that are not profitable at the time and buy into the debt, and when things turn around, shareholders tend to reap the benefit. I certainly believe that they will, being a consumer of the product and liking the business model. So that's going to be it for the ETF ARKK. I just wanted to share my thought process with you guys and let you know why I will be dollar cost averaging this to, one, give me some more diversification, and two, put the short-term buying and selling into the hands of a professional like Cathie Woods, who has a successful track record in the growth and innovation space. So make sure you hit the like button, make sure you hit the subscribe button, and as always, thanks for watching. See you guys tomorrow.